Hello, I'm Juliet Sarli. In this week's IG Macro Intelligence, we take a look at the wild swings in risk assets and where opportunities may lie. Recent volatility has roiled global markets as fears around Nvidia, the world's most valuable company, reignited investor caution. The S&P 500 slid nearly 2% over the course of last week, while Asian stocks also tumbled, and the S&P ASX 200 is on track for its worst November in over 3 years. Analysts are divided as to whether this is a correction or the start of a deeper bust.
I don't think anybody should be surprised that not only a correction, but a deep one is in the cards, particularly, Nadine, when you have such a weak economy. I mean, yeah, we had 119,000 jobs in September, but from May through September, 5 months of time, we've added something like 193,000 jobs in 5 months, which effectively is 40,000 jobs a month. You can't run the U.S. economy in a growth scenario with any cyclical gains with 40,000 jobs a month. And if you look into the internals of that September report, albeit late, there is no cyclical job growth. It's in education, it's in healthcare, and basically nothing else. That's not a strong economy either. So this is, basically everything's starting to line up. But I think people really got to put 20 to 30%, that this correction is 20 to 30%, not 5 to 10%.
However, on the other side of the coin, Morgan Stanley has upgraded its S&P 500 target to 7,800 points, seeing roughly 15% upside potential and the beginning of a multi-year earnings upswing.
Seeing an accelerated rate of investment by big tech into AI. And alongside that, adoption, monetization, all that's giving us further confidence. And more importantly, we're actually seeing a broadening out of this AI investment boom to benefit a much larger set of companies and the earnings related to those companies. And that's in addition to a whole range of policies that have been initiated in the US that are aimed at boosting investment, boosting CapEx, and in particular in the area of reshoring, bringing manufacturing back into the US. We actually think this is a real phenomenon now, and there's evidence that that's gaining pace.
So if markets do have further room to run, where should investors be looking? Well, Joel Fleming from Yarra Capital Management thinks 2026 will be the year for small to micro caps.
For us, we can get caught up in AI and Nvidia's moves and things, but at the end of the day, this data center capex, it's happening. We see a clear runway there, and we can find some of these stocks that are really well positioned.
And Fleming highlights SKS Technologies as one of the stocks he sees as well positioned. It's risen almost 96% over the past 12 months, and analysts see it poised for further growth, supported by a substantial pipeline of data center projects. Morgans expects the company's revenue to rise to $320 million and has lifted its price target for SKX to $4.25 from $3.80, signalling an expected upside of roughly 11%. The average recommendation is a strong buy, according to Refinitiv, with a $4.17 price target, suggesting a gain of around 9%. Meanwhile, Morningstar is predicting upside for retailers and the supermarket giants as cost of living pressures abate and in the lead up to Christmas.
But it's not a bonanza. It's not a shutdown bonanza that we saw a few years ago. And I think what some stocks are pricing in is like improving margins, greater sales. We're a bit more cautious. We think mid-single digit sales growth across the sector is probably a great outcome. So in terms of top picks, we think that some smaller stocks like Accent look really interesting at the moment. At the bigger end, at the larger cap end, we think things still look expensive if we think about JB Hi-Fi or Harvey Norman.
Well, Accent shares have fallen close to 60% over the past 12 months and appear to be in a long-term bearish trend. The 200-day moving average is falling, suggesting demand for the stock is low, and a signal investors see little opportunity in owning the stock longer term. Citi recently updated its target on the stock to a buy with a bullish $1.83 price target, suggesting 91% upside, but Morgan Stanley analysts see the stock falling even further to 95 cents. Well, Dean Fergie from Cyan Investment Management is another one of the view that some companies are too richly valued in the current environment, suggesting there could be a further 20 to 30% pullback.
A lot of investors appear to be sort of, second guessing that now. By and large, all those stocks are off kind of 20 to 30% in the last few weeks, and it looks like a trend that's sort of set to continue. Are they bad businesses? Absolutely not. Are they too highly priced in the marketplace at the moment, and particularly in light of a interest rate cycle that isn't looking as promising as it once did? I think they still look too expensive. So, put them on the watch list, but, probably like to see another 20% decline before they start to look really attractive on a sort of a more traditional long-term basis.
And Heath Moss from HLM Investments is also cautious heading into 2026.
The market keeps coming off, then 20% is on the cards, and I'd start to think that we could be headed that way. I mean, you got a bit of AI nervousness, and people are starting to want proof, proof of earnings, proof of return on investment.
And that is your IG Macro Intelligence for this week. We'll see you next week.